Welcome to Lukebook, Money and Wealth Building, explained for Singapore, not borrowed from somewhere else. In this episode, how everyday Singaporeans quietly build a $1 million portfolio that actually pays them passive income. Picture a number. $1 million. Not locked inside your flat, not the paper value of a property you still live in, but $1 million of liquid investments, working for you, paying you while you sleep. In Singapore, a growing number of ordinary people have quietly built exactly that. This is not a get-rich story, and it is not a secret. It is a look at the machine, the maths, the accounts, and the handful of habits that actually get someone there. Let's break it down, the Singapore way. First, let's be precise about the target, because most people get this wrong. We are not talking about your net worth. Your HDB flat, even fully paid, is where you live, you cannot eat it, and selling it just means you need somewhere else to stay. So we draw a hard line. On one side, your home. On the other, your portfolio, the stocks, the REITs, the funds, the CPF, the cash that can actually generate income. When we say a $1 million portfolio, we mean that second pile. The money that pays you. Keeping these two boxes separate, in your head and on your spreadsheet, is the very first habit of almost everyone who makes it. So how many Singaporeans actually pull this off? It is a surprisingly hard number to pin down. The most quoted figure comes from Henley and Partners, who count about 242,000 US dollar millionaires living in Singapore, one of the highest concentrations on earth. But read the fine print. That count includes the equity in a debt-free home, and it leaves out CPF entirely. So it is not a clean tally of people with $1 million in a liquid portfolio. The honest answer is, fewer than the headline suggests, but very far from impossible. It is a target a disciplined middle-class household can genuinely reach within a working lifetime. Now to the question that actually matters. Forget the number for a second. If you had a $1 million portfolio today, what would it actually pay you? Because $1 million is not really a goal, it is an engine. And the income that engine produces depends entirely on what you put inside it. Let's run the real Singapore numbers, as they stand in the middle of 2026. And one quick but important note, everything here is educational, the mechanics, not personal advice. Rates move constantly, and every figure you see is a snapshot in time. Start with the safest option there is, lending your money to the Singapore government. For a couple of years, this was beautiful. Back in 2022 and 2023, 6-month Treasury bills pay as much as 4%, completely risk-free. Then interest rates turned. By the middle of 2026, that same 6-month T-bill pays only about 1.5%. Singapore savings bonds tell the same story. The latest issues average barely above 1% in the first year. So if you park the entire $1 million in government paper today, your passive income would be around $15,000 a year. Safe, yes. But that is only about $1,200 a month, from $1 million. The risk-free floor has fallen out from under us. So the safe money barely pays anymore. This is exactly why income-focused Singaporeans turn to dividends, and the local favorite is the REIT. A real estate investment trust, or REIT, lets you own a slice of malls, offices, and warehouses, and it collects the rent on your behalf, paying most of it straight out to you. Singapore is one of the great REIT markets of the world. As of the middle of 2026, the average Singapore REIT yields around 5.9%, and many blue-chip names sit right around 6%. Put $1 million into a basket of solid REITs at, say, 5.5%, and you are looking at roughly $55,000 a year. That is the same $1 million, but nearly 4 times the income of the government bond route. The other great pillar of the Singapore dividend portfolio is the one you already bank with. DBS, OCBC, and UOB, 3 of the most profitable, best capitalized banks in all of Asia, and famous for paying big, reliable dividends. As of early 2026, DBS yielded close to 6%, UOB around 4.8%, and OCBC about 4.7%. One caveat worth knowing, part of that headline DBS yield comes from a special, temporary payout running through 2027, so the true ongoing yield is a touch lower. Even so, the local banks remain the backbone of many a Singaporean's passive income. $1 million split across the 3 would throw off somewhere in the region of $50,000 a year. If picking individual stocks sounds like work, there is a one-click option, the Straits Times Index ETF. Buy it, and you own all 30 of Singapore's largest listed companies in a single trade, the banks, the REITs, the conglomerates, all of it. It has been a quietly spectacular couple of years. The index pushed past a record high above 5,000 points in 2026, returning around 27% over 12 months. But here is the catch for an income investor: when prices rise, yields fall. After that rally, the STI ETF distributes around 3.4%. Lower income than REITs or banks today, but far more diversified, and you are buying the whole market's growth, not just its dividends. Put it all together, and a realistic Singapore income portfolio, a blend of REITs, bank shares, and the index, yields somewhere around 5% today. On $1 million, that is about $50,000 a year. A little over $4,000 every single month, landing in your account, whether you go to work or not. That is the price. That is what the number actually buys you, not a Lamborghini, but the quiet freedom of a second salary that never clocks in and never clocks out. Now, there is a famous rule you have probably heard, the 4% rule. It says that if you withdraw 4% of your portfolio a year, your money should last about 3 decades, topping up the dividends by selling a little along the way. 4% of $1 million is $40,000 a year, about $3,300 a month. For one person, that is livable in Singapore. For a family, it is tight. And that leads to an uncomfortable truth the gurus rarely say out loud. In 2026, with rates low and the cost of living high, $1 million may be the start of financial independence, not the finish line. Many now quietly aim for 1.5 or 2. But the path to all of them is the same path. So let's walk it. Here is where Singapore hands you something almost no other country has, and most Singaporeans walk straight past it every day. It is called CPF. To the rest of the world, a forced savings scheme sounds painfully dull. But one man looked at CPF and saw a money machine hiding in plain sight. His name is Lu Cheng Chuan, known across Singapore simply as Mr. CPF. In 2018, he revealed that he and his wife had accumulated $1 million in their combined CPF accounts before the age of 45, roughly 20 years ahead of schedule. He turned it into a movement with a name, 1M65. $1 million, by age 65. So how does it work? The secret is one specific account inside CPF, the special account. While your ordinary account earns 2.5%, the special account is guaranteed to earn 4% a year, guaranteed by the government, rain or shine. 4%, risk-free, is extraordinary. Remember, government T-bills out in the open market pay only about 1.5% today. The CPF special account quietly pays nearly triple that, guaranteed. And for younger members, there is an extra 1% on your first $60,000 on top. The 1M65 strategy is simply this: get money into that 4% account as early in life as you possibly can, then let compounding do the heavy lifting. Let's make that concrete, because the power of it is genuinely hard to believe until you see it drawn out. Suppose you manage to build up $200,000 in your special account by age 35. Then you stop. You never add another single cent. You just let that guaranteed 4% compound, completely untouched, for 30 years. By the time you turn 65, that $200,000 has quietly become more than $648,000. You more than tripled your money, risk-free, guaranteed, while doing absolutely nothing. Now picture a couple, each doing some version of this, and you can see how $1 million by 65 stops being a fantasy and starts being simple arithmetic. Mr. CPF's advice has a subtle twist that catches people out. Because that special account already pays a guaranteed 4%, he treats it like the safest bond he owns, and leaves it completely alone to compound. The money he wants to invest more aggressively, in stocks and funds, comes from elsewhere. Now the honest caveats, because they matter. That 4% is a flaw the government reviews each year. It is promised, but not promised forever. And the rules do change. Since 2025, the special account closes once you turn 55, with the money moving into a retirement account. So 1M65 is really a strategy for your younger, accumulating years. Start early, or the magic simply has less time to work. Before we look at what the millionaires actually hold, you need to understand why building wealth in Singapore is, frankly, on easy mode compared to most of the world. 3 words: no capital gains tax. When your shares double, and you sell them, Singapore takes nothing. In America, that same gain could be taxed up to 20 or 30%. And it gets better. Dividends you receive from Singapore companies? Tax-free in your hands. And when you eventually pass on, there is no inheritance or estate tax at all. It was abolished back in 2008. Compounding's single greatest enemy is tax dragging on it, year after year. In Singapore, for the ordinary long-term investor, that drag is close to zero. It is a structural gift, and most locals do not even realize they are holding it. But there is a trap, and it catches Singaporeans constantly the moment they invest overseas, which almost everyone eventually does, because you should not bet your entire future on one small island stock market. The temptation is to buy American, the S&P 500, the famous US-listed ETFs everyone talks about. The problem: the United States charges a 30% withholding tax on dividends paid to Singaporeans, because the two countries have no tax treaty. 30%, skimmed quietly off the top, every single year, forever. On a large and growing portfolio, that lost income compounds into a genuine fortune over a lifetime. So what do informed Singaporean investors do about it? They take a quiet detour through Ireland. There is a whole category of funds, Irish domiciled, the so-called UCITS ETFs, with strange tickers you will see again and again in local investing circles: IWDA, CSPX, VWRA. They hold the exact same global and American companies as the US versions. But because the fund itself lives in Ireland, which does have a tax treaty with the United States, the dividend tax drops from 30% down to 15%. Same stocks, half the tax leak. This single, almost hidden choice, buying the Irish version through a broker like Interactive Brokers, is one of the clearest dividing lines between the Singaporean who has read the fine print and the one who hasn't. There is an even sharper reason to take the Irish route, and it is the one almost nobody talks about. If you hold US-listed shares directly, and you pass away, the American taxman can claim up to 40% of everything above just $60,000, under what's called US estate tax. A Singaporean with $1 million sitting in US-listed funds could leave their family facing a bill of over $300,000 US. The Irish domicile funds sit outside America's reach and sidestep this almost entirely. Same underlying companies. One version is a quiet tax trap waiting for your family, the other simply isn't. Details like this are not trivia, stretched over a lifetime, they are the whole difference. So when you add it all up, what does a typical Singaporean self-made millionaire's portfolio actually look like? There is no single right answer, but a common shape tends to emerge, and it is far less exciting than people expect. A bedrock of CPF, compounding at 4%, treated as the bond portion. A core of global stocks, held through those Irish domiciled ETFs, for long-term growth. A layer of local dividend payers, the banks and the REITs, for income you can actually feel each quarter. A slice tucked inside the SRS account for the tax break. And some cash, always, for emergencies and for opportunities. Boring, diversified, and quietly relentless. That is the real look of it. The SRS slice deserves a moment of its own, because it is a rare piece of almost free money. The supplementary retirement scheme lets you put in up to $15,300 a year, and here is the trick: every dollar you contribute is taken off your taxable income. If you are a higher earner taxed at, say, 15%, putting in the full amount hands you back over $2,000 in tax, instantly. You then invest that money so it grows, and when you finally withdraw it in retirement, only half of it is taxed. For a business owner or a high earner, ignoring SRS is simply leaving money on the table, every April. Now the part that no account and no clever ETF can ever do for you, the habits. And the first one is the hardest of them all. Charlie Munger, Warren Buffett's late business partner, was once asked for advice by a young man. His answer was famously blunt. The first $100,000 is a bitch, pardon his phrasing, but you simply have to do it. And here is why he is right. At the very start, your own savings do all of the heavy lifting, your investment returns are tiny and feel pointless. But once you cross 100,000, the returns themselves start to matter as much as your saving. At 100,000, a 10% year is $10,000, a sum you would have struggled to save by hand. The pile begins to grow on its own. The first 100K is slow and painful. After that, it quietly accelerates. Which raises the real question: how do you get to that first 100,000, and then well beyond it? Not by picking better stocks. By saving more than you spend, aggressively, and on purpose. The people who build seven-figure portfolios on ordinary salaries almost all share one deeply unglamorous trait: a high savings rate. Not 10%. Often 30, 40, sometimes even 50% of everything they earn. The principle is older than the stock market itself: pay yourself first. The instant your salary lands, a fixed share goes straight into investments, before rent, before food, before any wants. You do not invest whatever is left after spending. You spend whatever is left after investing. That one reversal changes everything. The second habit removes the single most unreliable part of any investment plan: you. Left to our own feelings, we tend to buy when markets feel exciting and sell when they feel frightening, which is precisely backwards. The fix is to take the decision out of your hands entirely. Automate it. Set up a standing instruction that buys the same amount of your chosen fund every single month, no matter what the headlines are screaming that week. This is called dollar cost averaging. When prices are high, that fixed sum buys a little less. When prices crash, it automatically buys more, on sale. You stop trying to time the market, a game that almost everyone loses, and you let plain consistency win instead. The boring machine beats the clever gambler. The third habit is a kind of patience that, from the outside, can look a lot like laziness. When those dividends and distributions land, the millionaire in the making does not spend them. They reinvest them, buying more shares, which pay more dividends, which buy still more shares. This is the snowball, and it only works if you let it keep rolling. And when the crash finally comes, and it always comes, they do nothing. They keep buying right through it. History is brutally clear on this. The investors who panic sold in 2008, or in early 2020, locked in their losses and then missed the recovery. The ones who simply sat still, and kept their monthly buying going, came out far ahead. Time in the market beats timing the market. Wealth here is less about brilliance, and much more about not flinching. The fourth habit takes us right back to where we began. Keep your home and your wealth in two separate boxes. In Singapore especially, it is dangerously easy to mistake an expensive flat or a shiny condo for actually being rich. But your home pays you nothing each month, it quietly costs you. The people who reach a real million-dollar portfolio resist the powerful urge to pour everything into ever bigger property. They buy a home they can genuinely, comfortably afford, and then they relentlessly feed the portfolio that actually generates income. The house keeps you sheltered. The portfolio is what sets you free. Never confuse the two. Now the mistakes, the ones that quietly destroy portfolios that really should have made it. The biggest, and the most Singaporean of all, is overconcentration. Putting far too much of your entire wealth into a single stock that you love. And in Singapore, that one stock is very often a local bank, held by someone who has watched it rise for decades and simply cannot imagine it ever falling. Here is the danger. A portfolio that is 80 or 90% in one company is not really an investment, it is a bet. One scandal, one bad decade, one wave of disruption, and a lifetime of patient saving takes a blow it may never fully recover from. The fix is not to sell everything that's good. It is to make sure that no single name can ever, by itself, sink the whole ship. Diversification really is the only free lunch in investing. The second trap is the most seductive one, chasing yield. You will see it everywhere, some obscure stock or REIT advertising a 10, 12, even 14% dividend. Your eyes light up. But in investing, an unusually high yield is almost never a gift, it is a warning. The price has usually collapsed precisely because the market is expecting the dividend to be cut. Investors who pile in just for that headline number very often watch both the dividend and the share price fall together, losing income and capital at the same time. A boring, sustainable 5% that keeps paying for 20 years will quietly crush a thrilling 12% that gets slashed within 2. In income investing, reliability beats the headline rate every single time. And then comes a cluster of quieter killers. Overleveraging on property, borrowing right up to the hilt for a second condo, and silently praying that interest rates stay low. Market timing, sitting in cash, waiting for the perfect crash that never quite arrives, while the market climbs on without you. Overtrading, buying and selling constantly, bleeding fees and almost always underperforming the person who simply bought and held. And the slowest poison of them all, lifestyle inflation. Every pay rise swallowed whole by a bigger car, a nicer condo, a longer holiday, so that no matter how much you earn, nothing ever actually reaches the portfolio. You can out-earn almost everyone around you and still never build any real wealth, if your spending quietly rises to meet every new dollar. So let's bring it all home with the only equation that really matters: how long does this actually take? The honest answer is that it is driven by two things you partly control: how much you invest each month, and the return you earn on it, and one thing you don't: time. Here is what it looks like in practice. Invest $1,000 a month at a 5% return, and you reach $1 million in about 33 years. Push that to $2,000 a month, and it drops to 23 years. 3,000 a month at a slightly higher 6% return, and you are there in around 16. The lesson leaps right off the table. The amount you save moves the finish line far more powerfully than chasing an extra % of return ever will. Saving is the lever you actually control. So pull it hard. Let's watch one of those actually play out. $2,000 a month, a real stretch, but achievable for many dual-income households, invested steadily at 5% a year. For the first few years, it crawls. It genuinely feels pointless, the line barely lifts off the floor. But watch closely what compounding does in the back half. The curve bends upward, gently at first, then steeply, as the returns start to dwarf your own contributions. By a little over 2 decades in, you are standing on roughly $1 million, and most of it is growth you never once earned at a job. This is the entire game, captured in a single picture. Start, stay consistent, and give it enough time. So there it is, the Singaporean path to $1 million portfolio, stripped of all the hype. Separate your home from your wealth. Understand that $1 million today pays you around $50,000 a year, not a fortune, but a real freedom. Use the machines this country quietly hands you, the 4% CPF special account, the no tax on gains advantage, the SRS break, the Irish ETFs that plug the tax leak. Build the habits, grind out that first 100,000, save aggressively, automate it, reinvest everything, and never flinch in a crash. And avoid the traps, concentration, yield chasing, and the slow, silent leak of lifestyle inflation. None of this is a secret, and none of it is fast. It is simply arithmetic, plus patience. The maths has always worked. The only real question left is whether you will give it the time. I'm glad you spent some of yours here today. Take care. Thanks for watching. If this made building wealth in Singapore a little clearer, give it a like, and subscribe to Lukebook so you don't miss the next episode. See you in the next one.